$4 to $6 trillion. That is the estimated size of the yen carry trade still outstanding. Money borrowed in Japan at near zero rates and invested in higher-yielding assets around the world. BCA Research called it a ticking time bomb, and the fuse is getting shorter because the Bank of Japan is hiking rates, while almost everyone else in Asia is cutting or holding. We are watching the most dramatic central bank policy divergence in Asia in at least a decade.
Welcome back to Asia Tech Macro. I'm Maya, and today we're connecting dots that most people analyze in isolation. The yen at 156 per dollar, the Korean won near 16-year lows, the Indonesian rupiah at 16,985, the Indian rupee having been cut 125 basis points from its peak rate. 4 major Asian central banks, 4 completely different strategies, and the collision between them is creating opportunities and risks across every asset class in the region.
Let me lay out the 4 players because the divergence is striking. First, the Bank of Japan. Governor Ueda held rates at 0.75% in March, the highest level since September 1995. The vote was 8-1, with board member Hajime Takada dissenting in favor of an immediate hike to 1%. The BOJ explicitly signaled it will continue raising rates if growth and inflation unfold as projected. Japan's spring wage negotiations delivered over 5% wage increases, which gives the BOJ room to tighten further. ING analysts expect the next hike in April or June 2026, depending on how the Middle East conflict affects oil prices and inflation.
So Japan is the lone hiker in Asia.
The only major central bank in the region actively tightening. Now let's look at India. The Reserve Bank of India went the opposite direction. Under new Governor Malhotra, the RBI cut rates by a cumulative 125 basis points, from 6.5% down to 5.25%. Indian inflation hit a 47-year low of around 2%, well below the RBI's target band, which gave them enormous room to ease. India's GDP growth forecast for 2026 is 7.5%, the strongest in Asia.
So India is cutting aggressively and growing fast. What about Korea?
South Korea is frozen. The Bank of Korea has held its base rate at 2.5% for 6 consecutive meetings through February 2026. 60% of Korean economists surveyed expect no rate change at all this year. The Bank of Korea is trapped. They can't cut because the won is near 16-year lows against the dollar, and household debt remains elevated. They can't hike because the economy is only growing at 1.8%, and they need the semiconductor recovery to continue. Governor Ri is essentially waiting for external conditions to change.
And Indonesia?
Bank Indonesia is in the most difficult position of all. They held the BI rate at 4.75% in March, while the rupiah weakened to 16,985 per dollar, down 1.29% from February. The Middle East conflict triggered capital outflows from emerging markets, and Indonesia is highly vulnerable because of its large current account deficit and dependence on foreign portfolio investment. Real rate differentials between Indonesia and the U.S. have narrowed by more than a full percentage point since November 2025, adding pressure on the rupiah. BI has maintained an easing bias, signaling it wants to cut to support growth, but cannot because currency stability takes priority.
So we have Japan hiking, India cutting, Korea frozen, and Indonesia wanting to cut but being blocked by currency weakness. That is an extraordinary divergence.
And the common thread connecting all 4 is the U.S. dollar. The Federal Reserve's reluctance to cut rates in the first half of 2026 has kept the dollar strong, which tightens financial conditions across all of Asia whether individual central banks want it or not.
Let's dig into the yen carry trade because you opened with that eye-catching $4 to $6 trillion number. How does the BOJ's hiking cycle create systemic risk?
The yen carry trade is one of the most important and least understood dynamics in global finance. Here's how it works. For over 2 decades, Japan had the lowest interest rates among major economies, essentially zero or negative. Investors, hedge funds, and institutions borrowed yen cheaply and converted it to dollars, Australian dollars, Brazilian reals, or other higher-yielding currencies to invest in assets that pay more. The profit is the spread between the borrowing cost in yen and the investment return in the other currency.
And with Japanese rates near zero, that spread was enormous.
Exactly. A fund could borrow yen at 0.1% and invest in U.S. Treasuries at 4.5%, pocketing a 4.4% annualized spread with leverage amplifying the returns. The problem is that this trade requires 2 conditions to remain stable. Japanese rates need to stay low, and the yen needs to stay weak or stable. When the BOJ hikes rates, the borrowing cost rises, and if the yen strengthens because of those hikes, the currency move can wipe out the carry profit entirely.
And we saw exactly this happen in August 2024, right? The yen carry trade unwind that crashed markets.
That was a preview. In July and August 2024, the BOJ hiked unexpectedly.
The yen strengthened sharply, and carry trade positions were unwound rapidly. The Nikkei 225 dropped over 12% in a single day, the worst since Black Monday in 1987. Global markets experienced a flash crash, and that was triggered by a relatively modest BOJ move. Now the BOJ is at 0.75% and heading to 1% or higher. Each hike narrows the carry spread further and increases the risk of a more violent unwind.
The Japan Times literally quoted BCA Research calling the yen carry trade a ticking time bomb.
And the numbers back that up. The estimated $4 to $6 trillion in outstanding carry trade positions means that even a partial unwind would move enormous amounts of capital. A sustained move below 150 yen per dollar could trigger what analysts describe as the fastest, most violent unwind since 2008.
Let's look at how this connects to the other Asian economies. How does the yen carry trade affect Korea, India, and Indonesia?
In two major ways. First, direct flows. A lot of yen carry trade money is invested in Asian assets, Korean bonds, Indian equities, Indonesian government debt. When the carry trade unwinds, that money flows back to Japan, creating selling pressure on Asian assets and currencies simultaneously. This is exactly what happened in August 2024, and it would happen again.
So when the yen strengthens, everyone else weakens.
That's the mechanical relationship. And second, indirect effects through risk appetite. A carry trade unwind is a risk-off event. Global investors reduce exposure to emerging markets, pull capital to safety, and the dollar strengthens further. This creates a vicious cycle for countries like Indonesia, whose currency weakens, which forces Bank Indonesia to keep rates higher, which slows growth, which makes the country less attractive to investors, which weakens the currency further.
Indonesia seems particularly vulnerable.
Indonesia has the weakest structural position of the four. Their current account deficit means they depend on foreign capital inflows to fund imports. When those inflows reverse, the rupiah drops, and inflation rises through more expensive imports, especially oil. Bloomberg reported in March that Indonesia has tightened rules on dollar buying to stem outflows. When a central bank starts implementing capital controls on the margin, it tells you the pressure is real.
And Korea's situation is interesting because the won's weakness seems to be driven by multiple factors, not just the carry trade.
Korea has a unique cocktail of pressures. The won is near 16-year lows because of the political instability from the martial law crisis and impeachment in late 2024 to early 2025, combined with the broader dollar strength. The BOK cannot cut rates without risking further won depreciation, which would raise import costs and stoke inflation. But the economy is growing at just 1.8% and depends heavily on the semiconductor cycle continuing. ING noted that the BOK's easing cycle may be over entirely, which leaves the economy without monetary support at a time when it arguably needs it.
Contrarian corner. The consensus view is pretty bearish on Asian currencies in 2026. Strong dollar, BOJ hiking creating carry trade risk, weak won, pressured rupiah, and the Middle East conflict adding energy cost inflation across the region. Alex, what's the case for optimism?
The contrarian thesis starts with India, which I think the market is underappreciating. ING's Asia FX outlook for 2026 explicitly calls the rupee one of the few high-yielding Asian currencies with genuine upside potential. Here's why. India cut rates aggressively, but it did so from a position of strength, not weakness. GDP growth at 7.5%, inflation at a 47-year low of 2%, FDI at a record $80.6 billion, and the Trump-Modi trade deal that reduced tariffs from 50% to 18%. If the trade deal holds and domestic consumption continues to strengthen, the rupee could stage a meaningful reversal from its recent weakness.
So India is the exception to the bearish Asian currency story.
That's my read. And the contrarian angle extends to the yen carry trade itself. Everyone is focused on the downside risk of an unwind, but consider the other side. If the yen carry trade does partially unwind and the yen strengthens, Japanese corporate earnings on overseas operations get a haircut in yen terms. That's bad for the Nikkei in the short term. But a stronger yen reduces import costs for Japan, which is a net energy importer like Indonesia. It eases inflationary pressure, which gives the BOJ more room to manage its tightening cycle gradually rather than being forced into aggressive hikes.
So a controlled yen strengthening might actually be what the BOJ wants.
I think Governor Ueda would welcome a move to the 145 to 150 range. It would demonstrate that the normalization is working, reduce imported inflation, and make the carry trade unwind more gradual rather than explosive. The problem is that currency markets rarely deliver controlled gradual moves. They tend to overshoot, which is why the $4 to $6 trillion carry trade overhang creates tail risk, even if the base case is manageable.
Let me raise another contrarian angle. Korea's won weakness might actually be a competitive gift. A weak won makes Korean exports cheaper. Samsung's memory chips, Hyundai's cars, and Korean cultural exports all benefit from a depressed currency.
That's the Samsung paradox we've discussed before. Samsung's record 20 trillion won Q4 profit was partly driven by the weak won translating dollar-denominated chip sales back into more won. SK Hynix benefits similarly. So while the BOK can't cut rates to support growth, the weak won is doing some of the stimulative work for them by boosting export competitiveness. The semiconductor sector, which Korea depends on, is dollar-denominated in revenue. A weak won is essentially a subsidy for Korean chip exports.
But that only helps the export sector. Domestic consumers face higher import prices.
Exactly. And this is where the K-shaped pattern we discussed in Taiwan's episode appears in Korea too. The semiconductor giants benefit from won weakness. Domestic service sector workers and consumers bear the cost through more expensive fuel, food imports, and consumer goods. The BOK is stuck because the policy that helps Samsung hurts ordinary Koreans.
There's a broader question here about whether the dollar strength is sustainable. If the Fed finally cuts in the second half of 2026, doesn't that relieve pressure on all Asian currencies?
That's the single most important variable for this entire episode. Fed rate expectations are the gravitational force that pulls all Asian currency dynamics. MUFG Research's Asia FX Outlook describes 2026 as returning to divergent fundamentals, meaning that once the Fed moves, each Asian currency will trade on its own merits, rather than being compressed by uniform dollar strength. If the Fed cuts 50 basis points in the second half of 2026, the won and rupee likely rally, Indonesia gets room to ease, and the carry trade risk diminishes. If the Fed delays into 2027, every risk we've discussed intensifies.
So the entire Asian central bank story in 2026 is really a Fed story in disguise.
Action items. How should investors and business professionals navigate this central bank divergence?
3 specific actions. First, track the BOJ's April and June meeting dates as the highest impact events for Asian markets in Q2 2026. Board member Takada already dissented in favor of a hike to 1%. If the spring wage negotiations confirm 5% or higher wage growth, and if the Middle East conflict pushes oil prices above $90 per barrel, the probability of an April hike increases significantly. Any BOJ hike will send the yen sharply higher and create ripple effects across Asian currency markets. The specific level to watch is 150 yen per dollar. If the yen strengthens past 150, carry trade unwind accelerates, and you'll see selling pressure on Asian equities, particularly those funded by yen-denominated leverage. Set alerts on the dollar-yen rate and track the CME FedWatch tool for U.S. rate cut expectations simultaneously. The interaction between BOJ hikes and Fed holds is the most important macro pair trade in the world right now.
Second,
differentiate your Asian emerging market exposure by central bank positioning. This is not a market where you can be generically long Asia. India is the structural outperformer. Low inflation, high growth, rate cuts from strength, and a favorable trade deal. If you have to pick one Asian market for 2026, the data points to India. Indonesia is the most vulnerable, with a weak rupiah, capital outflow risk, and a central bank that can't ease. Korea is in the middle, benefiting from semiconductor exports but constrained by political uncertainty and won weakness. For portfolio construction, overweight India and underweight or hedge Indonesia exposure. Track Bank Indonesia's dollar buying restrictions as a canary in the coal mine. If BI implements further capital controls or draws down reserves sharply, it signals that the pressure is becoming unmanageable.
and third,
for any business with operations across multiple Asian countries, audit your currency exposure and hedging strategy now. The divergence means that yen, won, rupee, and rupiah will move in different directions based on their respective central bank policies. If you earn revenue in yen and have costs in rupiah, the BOJ-BI divergence creates a natural hedge that you should understand and potentially lean into. If you have yen-denominated debt and dollar-denominated revenue, a yen strengthening episode would reduce your debt burden. Conversely, if you source from Korea and sell in Indonesia, won depreciation benefits your costs while rupiah weakness hurts your revenue. Map your cash flows against each currency pair and talk to your treasury team about whether your existing hedges reflect the divergent policy paths we've outlined.
The big picture takeaway is that 2026 is the year where analyzing Asia as a single block stops working. Each economy is responding to different pressures with different tools, and the outcomes are diverging dramatically.
And at the center of everything is the yen carry trade, $4 to $6 trillion of leverage positions that are sensitive to every BOJ meeting, every U.S. jobs report, and every Middle East headline. It's the thread that, if pulled, unravels positions across every asset class in Asia. Understanding how that thread connects to the won, the rupee, and the rupiah is the most important analytical framework for Asian markets this year.
And if you want the full currency-by-currency analysis, the carry trade math, and the central bank meeting calendar with our probability assessments, we publish a free daily newsletter at asiatechmacro.substack.com. In our next episode, we're going to look at the Alibaba Cloud versus AWS versus Google Cloud battle for Asia's cloud market. Alibaba just committed $52 billion to AI and cloud infrastructure, and the competition for Asian enterprise customers is intensifying across every metric. Cloud margin wars, sovereign AI mandates, and data localization requirements are all in play. That's going to be a fascinating one. Thanks, everyone.
Stay data-driven. Bye.